Hello my fellow freedom builders, and welcome back to another video here from my channel. Today I am gonna make a video that I promised you for quite a while, and that is where I am diving into some major gold mining stocks to see which of them I would prefer if I were to invest in gold mining stocks. As you might remember, I did a video a while back. If you haven't seen it, I'll link to it below, where I dived a bit into what was important when you were looking at gold mines. And I talked about the fact that there is this extra layer of risk when you are looking at gold mines. And some of that is that you of course have the company risk. It can be poorly managed or very well managed, but there's also a speculative price risk, because the commodity that they produce, that could be gold, that could be copper in many instances here, is also a product that is a speculative commodity that goes very much up and down in price depending on the overall world economy. So that is of course something we should mention today. I also mentioned that there were two types of gold mining stocks, or the majors, and that is companies that are already functioning. They're producing a profit. You can compare them to, for instance, an oil company or something like that. So they are actually like a manufacturer of gold, and you can look at their gold reserves and how much they produce each year and so on and so forth. And then there are the juniors, and they are often not up and running yet. So there you are putting your money into a bit more of a speculative stock, hoping that this will become a good stock. So what I am going to do today is I'm going to make a quick analysis of 5 of the major stocks, and I have picked them I have gotten a lot of questions about gold stocks, and I have picked some of these that I've got most questions about, and then picked the largest of these. And that is the Newmont gold mining stock. There's the Barrick Gold. It is Agnico Eagle Mines. It is AngloGold Ashanti, and it is Kinross Gold. And these are the 5 I'm going to take a look at today. And then in a later video, I'll have a look at some of the juniors as well. First of all, I should say that I'm actually not an expert in gold mines. Of course, I've looked at them from time to time, and also know the major players. But to be honest, if I were to invest in a gold mine today, I would probably take a look at the gold miners ETF instead, called GDX. I've found it here on ETF.com. That's a great site if you're going to look at ETFs. Here you can see how it is, how they're building the ETF, what their thoughts is about it, and you can see it is a momentum rising stocks here. You can see if they're strong on value or quality and so on. And down here, of course, you can see how they have gone this year. They have followed the gold miners pretty well, and that has been a great year for gold miners. They have outperformed the market. And you can see down here you can see the top 10 countries they are in, and here you can see the top 10 holdings, and you can see that the 5 I have picked today, Newmont, Barrick, Agnico, Anglo and Kinross, they are all a part of this top 10 in the GDX ETF. So let's have a look at it. First of all, now here we have the Newmont, but let's just have a look at something else first. And that is the price of gold. And as you can see, the price of gold has gone up quite a lot this year. Just since the beginning of January here, we can see that the gold is up something like 14%. And the gold miners, we can have the GDX here, just to have a look at that. Since January as well, around here, the GDX is up 21%. So it is actually up a bit more than the gold price. And if we are taking a look at the S&P 500, we can see here that since January 1st, the S&P 500 is actually down 7.4%. So the gold mines have been very, very good to be in this year. However, if you're looking at it on a longer time frame, it has been, if you have if you did hold it since, let's say, since 2010 here, they have been down and has absolutely not beaten the market. So it's not like gold minings are always great to have, but here in uncertain times it can be okay. So let's have a look at them. Let's start with the chart analysis, and what I'm going to do today here is I'm going to look at the charts to see are we in an up or a downtrend, and then I'm going to look at some of the fundamentals. I'm going to look at how they are priced right now, if that is good value. And if we start with the Newmont Corp here, US based, one of the really large players, they merged with a company called Gold Corp last year and got a lot of benefits as far as I can tell from that. They are saving quite a lot of money already now from these merger benefits. They have around 100 million ounces in reserves, and in 2019 they produced just above 6 million ounces, which is quite nice, especially since the gold price is going up, the oil is dropping. And yes, as we can see here, if you have seen my videos about my strategy, you know that I want the RSI on a weekly chart to be above 50, and I want the comparative relative strength here, where I compare, in this case, to the S&P 500. I want that to be above the 2 moving averages here, meaning that we got our first buy signal on the Newmont Corp back in December 19, around 42, and that has been up quite nicely since, and we haven't gotten a sell signal here on the weekly chart. You could have sold out from the daily chart here, but now we are actually bottoming out, and I think we are going to see a spike up here if we're just looking at the technical part. But let's have a look at the fundamentals, because if we're going to invest in gold minings, I think it should be not just speculative, at least not for the majors here. That should be more like a long-term investment. And if we look at the Newmont Corp here, let me just move this a bit so you can see all the numbers. Here we go. You can see here in Stockopedia, which is one of my favorite analysis tools. There's a link to it below here. I think they still run a 25% discount on the Stockopedia platform, actually. So you can just use the link below there to get the discount. As you can see here, I do like their scores to be above 70, at least the quality, the momentum, and the stock rank, and they are all well above here. You can see a quality rank of 79, meaning that they are better than 79% of all the rest of the stocks. Momentum, and that is both price momentum and momentum in earnings growth, that is also at very high levels here, and the overall stock rank at 85. So that is not because I'm just buying stocks that have above 70, but that is my first filter. If one of these are very low, I will have to dig in to see why. As we can see, the PEG ratio is very low. I like that to be below 2. And if you don't recall, then the PEG ratio is the price earning right now divided by the estimated growth in earnings. So that is, of course, something important here. We should notice that the gold mining stocks, of course, are they're very much affected by the world economics. So if everything goes down in a big black hole right now, we might actually see the gold miners go up. However, they have been quite affected by all of this virus lockdown we have seen, and many of the large gold miners, also Newmont here, they've been forced to close down some of their mines, and of course that will affect the results, no doubt about that. But we can see here the quality of the earnings, return on capital, and what I do like here is that it is both compared to the market but also to the industry, so that we can see they are actually very well established here with a return on capital of 9.8, return on equity and operating margins very nice. The Petrosky score that I made a video about the other day is at 6. That's quite okay. If you're looking at the graphs here, the EPS normalized going up in a very fine line. Just notice that the 3 last blue bars out there, the third last is the trailing 12 month. I'm actually not looking too much at that. And then we have the 2020 and 2021. That is estimates. And of course, estimates can change. But as we can see down here, we have free cash flow. That is very nice and growing. I do like to see the free cash flow here. They are not paying an extreme amount in dividend, but around 1% with a very nice dividend cover that I do like. So that is nice. Working capital is going up, and what I actually like to see is that of course that debt went up in 2019 because that was a merger with the Gold Corp, but they are lowering it again, and especially in this line of business where they have to either make mergers, they have to make some acquisitions, or they have to make entirely new projects, finding new mines. It is very good to lower the debt because that they will need the money probably at some point. You can see the interest coverage is 22.3. That is nice, and pretty much all the numbers are nice here. The analysts are saying buy, so that is great. If we are taking a look at the fast graph here, we can see that, and if you don't recall it, then the black one here is the price. We have the normalized PE ratio here over time, and we have the adjusted operating earnings growth rate here. And as you can see, what we do like to see is that if the price is hogging or oscillating around, for instance, here in the beginning, the growth rate down here in earnings, then all of a sudden it spikes up and it actually becomes overvalued. But as you can see, it doesn't matter that the price can't go up, but we are at a point right now where the price is actually very high compared to what is expected of the earnings. And if we take a look at the forecasting here, we can see that right now they are at a price earning of 35. And of course that can keep going up. We should recall that a mine like Newmont also, they don't just own gold mines, they also have a lot of copper. And copper is a problem for many of the mining companies because the copper is an industrial component, and especially with China, that was in a downfall earlier, and there might be coming some sort of second wave in the virus with some more shutdowns. Well, then there might be a problem with the copper prices, but that is another story here. What we can see is that if they can keep a price earning at 35, there can be some great earnings here over the next couple of years, definitely. But let's just imagine that they would have to move down to some sort of normal PE ratio, then including the dividends, they would be making somewhere around 10%, which is not that bad. If it all went a bit worse, we might see a loss here, but they might be a bit to the expensive side right now due to the very high rises. We can also have a look at the Guru Focus website here, also a website I do like to see to watch at. And what I do like to see is that, for instance, the cost of their of the capital, what we can see here is the weighted average cost of capital. They're paying around 2.9% for the money they borrow, and they have return on invested capital at 4.4. So what I do like to see is that the ROIC here, the return on invested capital, should be far larger than the cost of capital. This is not far larger, it is larger, however, and that is okay. So even though they're taking on some debt with the merger with Gold Corp, they're having a larger return on the money they borrow than the price they pay for it. And that is just simply a good business. All right, so let's move on to the next, and I'll make a little summary at last to say which one of these I actually think is the most interesting if I were to choose one. But the next one is Barrick Gold. All right, here we have the Barrick Gold. They are not quite as large as Newmont, but they are up there around the big players. They have 71 million ounces in the reserves. They produced 5.5 million ounces in 2019. They also have something like 13 billion ounces of copper in their reserves. And what I actually like with the Barrick Gold is that they are working very hard to I'm not certain you should say please the shareholders, but they are working very hard on bringing down debt and making the company as solid as possible. So as we can see here, just with Newmont, they are going up very fine here, and they are just establishing the price over the 20 moving average here. That is quite nicely done here. So that is basically the picture for the gold miners right now. If we're looking in Stockopedia, we can also see that the quality, the momentum, and the stock rank is well above 70, so that is great. The PEG ratio is also way below 2, so that is fine. And as we can see, EV to EBITDA, very nice. Return on capital, everything looks good here. The Petrosky score at 7, nothing wrong there. We can see that there have been some, the normalized earnings per share is not quite as stable. I know it looks like this, but remember the last 3 bars is 12-month trailing and then 2 times estimates. So if you're removing these, the normalized earnings per share is actually not very stable, and that's not really what I like to see, to be honest. Free cash flow, let's just see here. Also a bit unstable. They're paying around 1% in dividend and have a very nice dividend cover, but just in 2018 they didn't because they were losing money. But as you can see here, working capital going up, net debt is very much going down, and that is just like we like it, just as we like it to see. They have the current, the quick ratio, and the interest coverage here, very nice. And as you can see, the analysts also quite agreeing that this is a buy. If we're looking at the fast graph here, we can see that they have been in trouble. You can see here that the adjusted earnings here, minus 18%, minus 34, minus 73, minus 56, and then plus 133, minus 53. To be honest, that is too unstable for me. I do like to see earnings going up in pretty much a straight line. It is correct that they are estimating some more growth here and then some losses, but if we can see here, they were in a value zone, and here you can see that it is not enough just to be in a value zone. We should also see some of the other buy signals, because you could have bought in on a value stock, quote unquote, here at around $50 and then see it go down to $6-7 down here. But what I do like to see is that when I get my buy signals, they should come from a place where it is actually value. And right now it seems like we are hovering way above this value area. If we are going to look at the forecasting here, they really need to keep up their game with a large price earning here of 40, simply just to make it a good deal for us. If they were to get back to the normal normal PE, we would have an annual return on below 1%. So that is not really my kind of stock, to be honest. It can be a great company, and potentially it can go up hundreds of percent. I shouldn't say here, because as I said in the beginning, I'm not a gold mining expert. So there are so many variables with these gold mining stocks. Many of them have mines in Africa, in remote places in Asia, in Russia, and so on and so forth. So there are so many political risks here that I've already addressed in the first gold mining video. So I'm not, when I have a gold mining stock that is overvalued, and I know that I'm taking on a lot of commodity price risk and a lot of political risk, then that is not really a stock I personally would take a look at. All right, so let's move on to the next, which is the Agnico Eagle Mines. All right, here we have the Agnico Eagle Mines, and they are a Canada-based mine. They are a lot smaller than the first two. They have around 22 million ounces of gold in their reserves, produced around 1.8 million ounces last year. As you can see, their they have not really followed the overall mines in their movement here. From the beginning of the year until now, they are just about in break even. Of course, they were way down here, as many of them, and it went up 100%, but it has been somewhat more volatile and hasn't returned quite as much. Then, of course, you could take the stance that you said, well, all of the other gold mines have been going up, so this is just a bit behind. This is a lagger, so it will go up quite as much as the other. That might be so, but of course there could be some reasons for their lack of performance. Let's have a look at it here. The Agnico Eagle mines here, the quality, the momentum and the stock rank all are very fine. The PEG ratio is low. When we're looking at the quality down here, we can see it looks pretty much like the others. The normalized earnings per share have been quite unstable. It's not going up in a straight line. And as you can see, if we deduct the trailing 12 month and the estimates for 20 and 21, it is not looking anything like the kind of company I personally would like to invest in. But of course, if the estimates hold true, then it starts to look a bit better. Now, the free cash flow, simply looking at this number, could make me not invest in this gold mining stock, because what I do like to see there's a lot of free cash flow, because the free cash flow is the money that they're sitting in their pockets, in their bank vault, and saying this is what we have to invest with. This is free of all the accounting tricks you can do to show good profits. The free cash flow is actually what you have in your hands, and this is negative, and I don't like to see that. They are giving a dividend yield around 1, and you can see the dividend cover is 2, 3 here. But again, that is measured on the earnings per share. What I don't like to see is that the dividend is higher than the free cash flow per year, because then they have to find that money somewhere else. So when they are paying out paying out 1% here, they have to find that money somewhere. You can see they're paying out 50, 60 cents per share, but they don't have any free cash flow. Now, then they would have to dig into their cash reserves, or they would have to borrow money to pay that dividend. And that is not the kind of stock I like to see. We can see that the net debt is going up. Again, not something I'm too fond of, but of course there can be some good explanations. The working capital is going down. Then we have the trailing 12 month, which is up. And we can see that the analysts are pretty much just saying buy. I have a feeling that they are pretty much just saying buy to every gold mining corp right now due to the gold price. That is kind of the feeling you get when you look at it. They are pretty much the same place with all of these gold mining stocks. If we're looking at the fast graph here, we can see that the price has been oscillating around the normal PE here, and you could say that if it follows these estimates, then it looks quite well. Let's just look at the forecasting here. Here we go, and this is actually okay if they can move up, that they can keep below the normal PE here and still make quite a good profit. And if they move up to the normalized here, then there might be some very, very nice gains here over the next couple of years. But to be honest, when you combine this, because this is actually an okay picture, and of course, who wouldn't like 95% per year in return? But when you combine it with what I see here, and I do have to rely on their estimates being true, then I get a bit nervous, because it's just like, I do like good estimates, I do like a good pricing compared to these estimates, but I also like to see that they have been able to make these profits in a straight line better and better each and every year. Then I can trust the estimates. I'm not certain that I can trust here, and let's just see if we can look at their analyst scorecard. this is what I'm talking about here. What we can see here is that when we have a red mark here, they're doing worse than the analysts expected. The yellow, they're doing the same, and the green, they're doing better. So what we can see that just since 09, we have 1, 2, 3, 4, 5, 6 years out of 10, or out of 11 actually, where they have underperformed what the analyst estimated. And that is kind of a 50-50 here, meaning that I can't be certain that the estimates that I'm investing after here in the forecast, there's a 50-50 chance that they won't hold through. So that is not really something I'm comfortable with, and I would personally not look into this mine myself. So on to the next, that is the AngloGold Ashanti. And here we have it. It has the nice ticker AU, which is also the gold, the short for gold, of course. But what we can see here is a very nice trend. It is going up with the rest of the industry. Here's 27% this year, and they have actually gone up and established a price trend above the 20 SMA, so that is great. It is in a green zone, so technically this is a buy. If we're looking at the numbers here, we can see 81, 97 and 90. That is great, so there's nothing really disturbing here. A PEG ratio at 2.1, a bit larger than the other. That tells us that we are paying a bit more for the future growth here, but that can be okay. Return on capital, operating margins, the margins are a bit lower than the other candidates we have been looking at. Petrosky scored 7, looks okay. Normalized earnings per share. In 18 and 19, it went up very nicely, and then there are some estimates for the future here. Not quite as good as a curve that I would like to see, but at least better than the Agnico Eagle mines we looked at just a second ago. The free cash flow is positive, so that is good. It is not stable and growing steadily, but it is more acceptable again than with the Agnico Eagle mine. Working capital actually going slightly down, but here in the last trailing 12 month going very much up. I don't know the reason for that. We should look into that. Net debt is going slightly down, and that is actually very good, because when we look at the Guru focus here, we can see that this return on invested capital, they are getting around 6% in return on their invested capital, but they're paying 14.6% in weighted average cost per on capital. So they are actually borrowing money at a very high price, and the return on this money is quite low. Of course, you cannot set it up 100% like this, but this is a good ratio to look at, and I do like the return on invested capital to be at least twice as big as a WACC here, so not too nice to look at, and I think it would be a very nice idea for them to get their debt put very much down. As you can see, all the revenue, net income, there's some great projections here, but again, that is the estimates. Let's just look at here. 3 months ago we were close to a hold on the analyst, but now it is a buy, just about as with the rest of the industry here. When we look at the pricing here in fast graph, we can see that there's not a real trend to see that it has been hovering around the earnings growth or the normal PE. But what I don't like to see in a company I should invest in is this zigzag pattern here. Of course, if the estimates hold through here, we could make an okay earning. Let's just go into the forecasting here. You can see we are very low here in the forecasting on the earnings. So if the earnings growth are holding through here, we can make some very good money. Let's just have a look at the analyst scorecard. Yeah, well, this makes me a bit doubtful. You can see over the last 11 years here, there have been 1, 2, 3, 4, 5, 6, 7, 8 of them where they have underperformed the estimates. And some of them severely underperformed the estimates. So you can see here, that there were 15 analysts that 1 year forward were 63 cents. Now this was actually $1.26. They only made 2 cents. So that was quite the underperformance here. So to be honest, when I see a picture like this, I simply don't rely on this. It looks very good in theory, and it actually says that this could be good value, but when they have been so bad at keeping their or sticking to their projections, their estimates, then this is straight into the trash can. So again, another gold stock that I would probably not touch. All right, on to the last one, and that is the Kinross Gold. All right, here we are with the Kinross Gold, and just the same as with most of them and with the ETF, going up very nicely this year. Actually, one of the stocks that have gone up is up 48%, which is great. It was also beaten very much down, so from the bottom down here and over to now we are 150%. So congratulations to those of you that picked the bottom there. Not many, I guess, have been able to do that. So technically, no problem. Great picture, uptrend, bouncing here. So that could easily shoot up further if we're looking just at the technicals. When we're looking at the Stockopedia here, we can see the quality of the earnings are actually only 47, which is not above 70 as I like. The momentum is great and the overall stock rank is okay. If we're looking at the PEG ratio, 0.5, and that is because they have some great estimates for the future here. With their earnings per share growth forward on around 30%, so that is quite nice. EV to EBITDA is great. I am aware, and that might show up in the comments here, that some of the measurements I'm using here are a bit different in the mining business than in normal corporations. But what I do is that when I'm not an expert on the gold minings, I will have to take my normal tools and put it into work here, and as far as I can tell, it actually works quite well. We can see here that return on capital and so on is okay. Petrosky score is 7. There's a score here I haven't mentioned before, and that is the Altman C score, and that is a score that tells how likely it is for a company to go bankrupt. And this is actually down in the red area. Doesn't mean that it will go bankrupt, but it's just that it is absolutely not in the safe area. I'll do a video about the C score in a while. So earnings per share here, taking away the trailing 12 month and the 20 and 21 estimates, well, then we are pretty much in a very bleak territory here. Nothing that I would normally have a further look at here. The free cash flow also, take away the trailing 12 month, and you can see a very disturbing picture here, as at least in my normal method here. When we're looking at, let's see, working capital, not the best trend. Net debt going up, that can be okay if they are doing some good return on the debt they are taking on. We can see that they have an okay interest coverage and so on here. And as with the rest of the industry, the analysts are saying buy right now. That can quickly change. If we're looking at the fast graph here, again, a picture like this, personally, I would simply not buy into a pattern like this. What I do like to see in the earnings growth is something like this. Let's just remove this. I would like to see earnings going something like this with the estimates from here going upwards, and I would like to see the price dipping down here and start to dip up, so we have some very good upward potential. Because right now we are above the earnings, and we can see that we have pretty much stayed here for quite a while. If we're looking at the forecast here, again, it looks quite well. If the earnings are holding true, then yeah, we can make some very nice profits here. Let's just have a look at the analysts, and again we see this picture with 1, 2, 3, 4, 5, 6, 7 out of 11 that actually underperformed a lot, and then we have some outperformers here in 16 and 19, but that makes me doubt that I can really count on the estimates here. They could easily be down, and then I'm sitting with quite a shitty case. So basically, when I'm looking at the gold mining, the top 5 here, or at least the 5 I have picked, personally, if I were to invest in one of them or 2 of them maybe, I think I would go with the large players, maybe the Newmont and the Barrick and so on. But that is more because of their stability, bringing down debt and so on, running quite a nice business. But basically, I can say this is not a sector that I would go into right now. I know that there can be some macroeconomic issues here, and with the world maybe going into a crisis and so on, but that can also hit the gold miners, so they're not really 100% safe here. I know that people like to see that everything is good with the gold mining right now. We might see the gold price go up, especially if the US dollar goes down or even collapses somewhat. We might see the price of gold go up, and that could help the gold miners. But to be honest, what I am looking for, and you know that if you have followed me for a while, what I'm looking for is good, solid, stable stocks. And the picture here that I see with most of them is absolutely not stable. That is choppy, it is unpredictable. As we can see, they are in 6, 7, 8 out of 11 years. They are not fulfilling the estimates. That is simply not something I would put my money into. I know that many of you that are in gold miners are looking for some quick runs up, and that's not really what I've been looking at here. What I've been looking at is the stability in the forward projections, and can we see some value, because I do like the technical setups in most of the stocks. However, as I said, I do like to see a well-performing company that has been performing well over time, are good at meeting the estimates. They have some very nice positive estimates in the future, and then we see a good technical setup. At least if you are going into the gold mining sector for a longer term investment. Right now, personally, and that is just my opinion, I'm not a financial advisor, but personally, I would not move my money into the gold mining sector right now. That might be a mistake. It might be that in a year it is up 100%. But many of your questions in the emails and on Facebook and so on has been, what do you think about gold mining stocks? And well, now you know what I think. That's all for now. I'm sorry it went to be a bit of a long video. I hope you held on to the end here. Remember to subscribe to the channel, and I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.